Yeah, there was the economist, and now there is, so it was announced, the mathematician. I'm just an actuary. And just to pertain a little bit to our common situation, I will, it's not me that is saying this. I refer to one of the greatest economists in our time, a great thinker and a broad mind, and he said, economics is extremely useful as a form of employment for economists. What is the idea? The idea is he was very wary of the efforts, the massive efforts of economists to transfer methods and models from the natural sciences to the economics. Because economics is about the economy, which is a very, very complex societal and human phenomenon, very dynamic. It is hard to say what the economy will be in 5 years, 10 years, and not to mention the time perspective of a normal life insurance policy. The society is changing under the imperatives of technology, under the waves of migration, under changing resource supply. Wrangling over the resources can lead to conflicts, wars. Everything is uncertainty. And therefore, it is very difficult. Prediction is hard, especially about the future. That's what Niels Bohr said. And Galbraith, he added that economic forecasting, the only role of economic forecasting is to make astrology look respectable. So the problem here is that we're trying to predict something because there's a massive element of prediction in all these considerations. Assumptions are being made of what will happen over the years. It is all pure speculation. And I have no intention to say that I am, as a mathematician, is any better placed to predict in the future than the economists. Actually, I'm extremely skeptical to much of the actuarial mathematical literature that is coming up today, and has been doing so over the past couple of decades, that try to model the markets and the demography for the next 100 years, which is the normal maximum life length of an individual. It's all speculation. So, but you know, academics also need to make for a living, so that must be allowed. And the professionals, they are, of course, interested to play a role in the companies, and now they are in business again after the reintroduction of some kind of regulations. So we all have a vested interest in this. But I will take a very, very modest approach to the problem, at least in the beginning of my talk, and try and pertain to something that I'm quite sure that actuarial science is able to sort out. And that is starting with the pension crisis. The pension crisis is something that occurred apparently around 2000 when it was identified. In the UK, we had a government-appointed commission that looked into these matters and came to the conclusion, no surprise, that the main causes of this crisis were the faltering markets and the unexpected improvements in longevity. This is, in some sense, true, but I think it's partly a misrepresentation, because it is something that followed after the deregulation frenzy in the 80s. The insurance companies were set much more free in tariffing and in the design of products, and they started to lower premiums to make their products look affordable, and they weren't prudent enough in their assessment of the future liabilities that could occur, and so we had a crisis. All this was actually well managed in the good old days when we had proper regulation and prudent risk assessment. So I will start with that. And I chose to go very low-key in this presentation because there is no reason to complicate simple matters based in common sense with martingales and all this fancy stuff. So I will just do household calculation and remind ourselves of the traditional life insurance theory, life insurance with no visible economic demographic risk. There is a life insurance policy issued at time 0 and terminating at time capital T. The policy can be in a certain set of states. Starts, let us say, in state number 0. There's a filtration, that's a flow of information generated by this policy. And the payments are of the following types. BT is the total payments, benefits less premiums, paid in the time interval up to and including T. It develops as follows. In the first place, there are state-wise annuities going as, let us say, just for simplicity, we have a payment rate per time unit in each state J that the policy can be in at time T. So if the policy is in state J, then this rate is at work, and in a small time interval of dt, this will be paid. And then we have the assurances, which are payable with a sum BTJK upon the transition from state J to state K at time T, and that here is the counting process that indicates such a transition. So if there is such a transition in the small time interval from T to T plus dt, this one is 1, else it is 0. State indicators and counting processes, we can, for simplicity, say that these functions here, the payments, they are deterministic. And we can assume, just for simplicity, that we have a Markov process, so we have everything is governed by the simple transition probabilities, and we assume that the transition rates exist and are deterministic. And we also assume provisionally that the interest rate is deterministic. The principle of equivalence, which is fundamental in life insurance, states that the expected value of the discounted future payments, out minus in, should balance at 0. We can rewrite that in a form that is absolutely speaking for itself. In the small time interval from tau to tau plus d tau, we discount the things, the payments there. Here is the probability of being in state J at that time, upon which this annuity payment here is payable. So this is the expected annuity payments. And here are the expected assurance payments. Here's the probability of being in state J at time tau. Here is the probability of making a transfer to state K, in that case, upon which this payment is due. So this you can read aloud. speaks for itself. And the rationale of this principle is, of course, that if you have a large portfolio of n identical policies, then the mean result, economic result, will converge to this expectation by the law of large numbers. So this equivalence is a benchmark. If you charge a little bit smaller premium, then you will have a certain loss in the long term. If you charge a little bit more, you will have a certain profit in the long term. So this is a kind of theoretical benchmark value. Good. The reserves that by statute and regulation have to be provided are at any time, if the policy is in state J, then you should, so to speak, repeat the thinking behind the principle of equivalence and take the conditional expected mean value of the future discounted payments. That is what you have to reserve. And the policy should be arranged in such a manner that these reserves are always positive. And it has, of course, the same representation in very, very clear, readable terms. We can put up a differential equation for this, which of course starts from the terminal values, which are 0 at the term of the contract, and calculate backwards by this obvious Thiel's differential equation, which I suppose everyone here knows. Now, with economic demographic risk, then these rates, the interest rates and the mortality rates and all other vital rates are unknown at time t, hence they are, let us say, stochastic. I do not imply that there is a known and reasonable, realistic model for it. I just say they are uncertain, so they are in some sense stochastic. And there's information generated by the development of these rates. Suppose they are continually observable directly. It's an idealization, of course, because even if you can read the interest rates from the finance department in the company, these ones, the transition rates will have to be estimated, but we leave that aside. And conditional on the realized rates, interest and vital rates, we will have, in the limit, if we look at a big portfolio increasing in size of identical policies, that's just the motivation, of course, then it will converge to the conditional mean, given the realized indiversifiable rates. So it will be a conditional mean given these rates. And so equivalence must now mean that we should have equivalence with probability 1 for each realized development of interest rates and mortality rates. This can only happen if the payments are actually adapted to the development not only of the individual life, but of the indiversifiable indices. And now we shall see how we can do this. We have the with profit concept. Payments, baseline payments are guaranteed at time 0. They are designed by equivalence using a very prudent technical basis with elements R bar and mu bar, say. So we just make a provisional guess on the future development of these rates, and we put them to the very safe side. We are cautious. The technical surpluses that will emerge in the long term if everything goes well, as it should be if these rates were prudently chosen, the technical surplus can be defined as follows. It is the factual gains on the portfolio in the past, calculated on the factual realized rates, like this. So you just accumulate all these average payments with interest up to time t, and then you subtract the weighted mean of the state-wise reserves using the factual probabilities that have been realized. So we decompose the total calculation of the result of the policy at time t by using the realized rates in the past together with the prudent assumptions about what will happen in the future. So here we put in the pessimistic reserves, typically all of them set too high. At the end of the day, of course, at time capital T, this term will no longer be there, and here is a total accumulated surplus on this contract, which will be positive if everything was put to the right side. We can differentiate this using Kolmogorov forward differential equations for these ones, the Thiele backward for these ones, and just straightforward calculation on this, and find that the dynamics of the surplus is the obvious thing. It accumulates with interest, factual interest, and it accumulates with state-wise surpluses that are generated by the prudent assumptions. And they are very transparent. You have a surplus component coming from the prudent interest rate assumptions. You earn more interest on the reserves than you actually assumed. And second, you have systematic gains due to the prudent assumptions about the mortality rates and the disability rates and so on that have this form, which is less transparent, but this one is the sum at risk. And these here are the differences between assumed and factual transition rates. And we see that we will have positive contributions to surpluses in all states if we have set the interest rate to the safe side. So will always be less than, or the factual interest will always be greater than the assumed one. And we see to it that the sign of the difference between assumed and factual transition rates have the same sign as the sum at risk. We can recast the whole thing by integrating and see that the surplus at time t is the accumulated value of the average systematic surpluses generated per time unit in all the states through all the times. And this should be positive if it is implemented properly. Now these surpluses, they belong to the insured, so they have to be repaid. But the repayments are not part of the contract. They are to the discretion of the insurance company. They pay them back in arrears as the true rates materialize and be observed, and prudently, so that you don't pay out prematurely. And the purpose of it all is to make all the surpluses repaid, so that at the end of the day, the account will close at zero. So you will have to pay out some bonuses or dividends, but do it in a prudent manner, so that you at the end of the day will have paid back everything, but you postpone these repayments, of course, in order to keep the probability of ruin down to effectively zero. You do it so that you always have a reserve that is positive, and you do it in a manner that strikes balance at the end. Now there are two important remarks to make here. First, there are no model assumptions for R and for the mu's. You don't assume anything. You just observe the factual rates. You don't model them. And second, there is solvency for sure. There is no longevity risk because you have make prudent assessments at the very outset, and the whole contract is construed in such a manner so as to secure solvency. So the pension crisis wasn't necessary. There is no longevity risk, and this is, in a sense, very good news for the customers. In some sense, it is maybe bad news for this conference, and it is bad news for the professionals, and it's bad news for the academics, and it's maybe bad news for all the banks and the reinsurers who are now engaged in the bailing out the insurance companies and the pension funds from the risk they have created themselves. But this is the way it was done, and it was absolutely waterproof. I'll show you another variation of the same thing. I would call it perfect index-linked insurance. Today, it has been sort of rediscovered, and now they call it automatic balancing mechanisms. What I will do, and this is a small piece of very, very humble, though still original research, which I'm very, very proud to present to the conference. What I do is very, very simple. I specify some baseline interest rates and baseline transition intensities. Maybe they could be best estimates or something. They are not put to the safe side. That is not the point now. And next, I specify some baseline payments, annuities, and sums assured that are intended to sort of define the profile and the purpose of the product. And then I write in the contract that there will be factual payments that cannot be specified in nominal terms now, because they will follow the indices. They will follow the indices in a very special manner. I let these annuity and assurance payments be basically as the baseline things, but tilted in response to the movements of these troublesome indices that I cannot model and I cannot predict. If I do it in this manner, then insert these things into the expression for the discounted total result on the policy. It is just the same expression as we had before. This is the expected discounted result on this policy for the whole contract period under the realized indices, interest and mortality here and there. And if I put in these expressions, then hocus pocus, all the troublesome indices evaporate out of the equation, and I end up with something that depends only on things that I chose and that are known at time zero. It stands here. And this I can arrange by requiring that this baseline contract should have should satisfy equivalence. So in this way, I just adapt the payments to the factual development of the rates, and everything will balance at the end of the day. Not sensational, it's absolutely nothing spectacular about it, but it is a good idea. It just means that you look at what rates you have, and then you respond correspondingly, which means that, of course, there is no solvency problem for the company, because the entire longevity risk, which is not so big, actually, and in particular, the interest rate risk has been placed on the shoulders of the insured. Good. I now pass on to pensions. And we are moving a little bit now in the direction of comparison over generations and question what can we do in terms of seeing to it that everything is good for each individual generation, and possibly discuss the transfer of wealth between the generations. So now we have to bring in the calendar effect. It is not just one single cohort. So I have here a pension scheme introduced at time 0. At any time t, every person aged X pays an amount ATX per time unit. ATX is a premium before retirement. It's a contribution, and it is a benefit, so it has an opposite sign at the retirement age. So I set this retirement age. Now, without problematizing for the moment how the recruitment to the scheme is and what is the entrance rules and so on, just say that at time t there are LTX dx. This is a decrement series then. Members at age x plus dx at time t. So the total fund at time t is, let me call it UT. It has the following dynamics. It increases with the factual interest, and it increases or decreases with the movements on the account, which is in come all the contributions from those in the workforce, and out go all the benefits to those who are retired. That's quite obvious. Already from this, you can read some obvious facts. High interest will help. With fixed terms here, benefits that do not depend on time and aren't to be tinkered with, we can see we will have a problem if there will be fewer entrants and there will be more retirees. So if there is an increased or an improvement of longevity, this one here will be big. If there is a lack of recruitment in a pension scheme, maybe fertility rates going down, we have a smaller term here, we have a problem. So you can already read a little bit from this small equation. I continue. So recall what these ATX are. They are contributions for the people in the workforce. They are benefits for the retirees. With no initial fund, obviously the fund at time t is the accumulated value of all the payments for all the generations up to that time. I can make integration by part here to just visualize how the surplus or fund at time t is composed of contributions from individual generations. So I accumulate everything up to time t. I discount for each point of time in the accumulation period with the discount rate, factual one. And I have for the generation born at time S, I will have this calculation for its individual surplus. Equivalence on an individual basis for each generation, that is, means that this term here at the end of the life of this generation should balance at 0. This is probably inevitable in competitive voluntary schemes offered by private insurance companies, because they cannot remedy a deficit by raising the premiums, then customers will go away. So equivalence on the basis of the individual generation is sort of compelling for that sort of pension arrangements. So private annuities, they will always have to satisfy this. For occupational schemes, it is different, because in occupational schemes, you know, they are closed. You cannot defect, you stay there. So there is the possibility of actually transferring money even between the generations. And you can have defined benefits. Then everything here, both the contributions and the benefits and the retirement age, are controllable. And you can deviate from this requirement here by even transferring some money over between the generations. Defined benefits is said to have a problem because there's a promise built in there. So defined contributions, then you just leave this one fixed, and you are able to adapt this one to the development of the non-diversifiable indices, at least to the extent that you annuitize only upon retirement and use the savings to actually purchase an annuity at the current price. There is still a risk in it because there is still a future after the time of annuitation, of course. In state pensions, that's where maybe the generation aspect becomes very, very clear to see and is an issue to discuss. For state pensions, everything is controllable. At least in Norway, it is the National Assembly, or together with the ministry, that actually sets the contributions and the benefits at any time. And there's a massive transfer of wealth between the generations. This is nothing new on this planet. It was always the case. And we have a big sovereign fund built on oil revenue at the time when the barrel was at 100. It is the biggest sovereign fund in the world. It is being politically managed for the purpose of securing decent benefits, decent pension benefits for the population in a very long period to come. So that's a political thing. And okay, maybe this was not it. Yeah. A typical solution for state pensions is pay as you go. The contributions and the benefits are currently chosen so that the contributions match benefits on a global level at any time. So you just use the contributions at any time to pay out the benefits, which makes perfect practical economic sense. It's a real economic motivation for it. You just transfer purchasing power between groups in the population. And of course, there will be no accumulation of funds in such a scheme. So that is one possibility. There are many, many other possibilities. So the question now is, what can we do with these intergenerational transfers that seem to be an issue in occupational schemes, in state pensions, of course, in everything that is compulsory in some sense or comprises big portions of the population? I don't think in the real world that it is possible to base decisions on this for the next, with actually consequences for the next 50, 100 years on theoretical arguments and agreements made at time zero. Everything is dynamic. It is all politics. And the world is a very, very changing one, as I emphasized. And if we should manage to make a deal with our children or our successors in longer term, they can change it. And if we manage to allow ourselves maybe a higher pension than the others seem or find suitable, they will simply tax it. So guarantees has been a big issue in insurance mathematics over a period of time. They are evaporating out again, of course. But should we have maybe a tax guarantee associated with our pension arrangements? I mean, in the UK, where I'm currently residing, the pension history is very long, and it is a long, long story of politicians going to the pension pots to balance the books in times of public or pain to the public purse. So what we can do with theory about this, I'm not entirely sure if we can get very far, but of course you can always play with ideas. And I would say that as it presented itself in this very humble setup here, you can try and formulate it as a control problem. The thing is that you would probably have to take an infinite time horizon, so it is not a standard control problem for that reason. There are very complicated processes involved here. These here are actually subject to the random fluctuations of the mortality rates, which will appear in the exponent of the exponential, the survival, the probability. This one here is another problematic entity. Interest rates are fluttering between 20% in the 70s and minus 2% currently, and so on and so on. So it's very difficult, but already, and even from a theoretical point of view, it is very hard to formulate a manageable, feasible, optimal control problem. And what should the objective function be? And what should the optimal controls be? How should they be calculated? It's definitely not a matter of just making another crank on the Hamilton-Jacobi-Bellman handle. The idea of surplus and bonuses in the with-profit scheme could suggest a possible approach to this. I have really tried to do something sensible as an actuary on this, but I haven't been successful because I found the problem too mathematically difficult to formulate, that is. But we could now say, okay, We have these randomly developing rates. We have some mechanism bringing in new entrants in every small time interval. The number of members at age x plus x to x plus dx at time t is this, where you, of course, have the number of entrants reduced by the survival probability, which is a random field. It is not just a simple stochastic process. It moves with calendar time, but it has a value for each age. It's a very complicated object. And now we can just repeat the thinking from the with-profit policy and say that the surplus in this scheme will develop according to the following dynamics. It will accrue with interest, and then there are all the systematic surpluses created by good and bad results in terms of the realized rates. So we have to agree maybe on some baseline rates, and we have to agree on some projection of the typical reserves, not necessarily put very much to the safe side, but could be. And then we have to control the dividends that we pay back to these insured in such a manner as to achieve some objective that we have for this function. But how to pose that problem, how to find a good objective function to minimize or maximize, and how to perform the controls, that I leave to you. And you can take it home. You can take it home and try and fiddle with it as a mathematician. You don't need guarantees and option pricing. You don't need to model longevity, impossible problem, of course. But you will have to stick in some assumptions anyway, and you will have to do some very untraditional mathematics that is far beyond what at least I can understand for the moment, and far beyond what is published widely in the press, but has a potential of adding at least a little component of clear thinking into this discussion from a purely actuarial point of view. And yeah, there you are. The ball is in your in your half, and you can play with it. You're welcome. Thank you very much.
Yeah, I was just wondering, in terms of the original sort of like a model you were suggesting, what you need to use is prudent estimations or assumptions on rates of interest rates and mortality. But how, in terms of the actual real market at the moment, obviously you need to be competitive against what other people are offering in the market. I mean, how do you suggest you solve the problem if you're not paying bonuses until after the fact, in terms of actually attracting a large enough cohort to actually invest in your product to allow your product to succeed in providing the service you want to provide?
Now it's a little bit long and confounded question, but I think I have an answer. First, of course, competition is there. So there's an incentive for insurance companies to try and sell their products at a kind of affordable price to attract customers. There's also an incentive on the part of the insurers to try and change and make variations of the products, equip them with guarantees and all sorts of opacity so they are not so easily comparable, because if they are comparable, then the price will be all you need to check. all these malpractices, they could be sorted out with proper regulation. We had proper regulation up to about 1980. I was myself serving on the Norwegian Council of Insurance Supervision. We controlled everything. Even the products were licensed, not only the companies, the products were licensed, the tariffs were licensed, everything was controlled. And competition was actually not so much an issue, because the insurance companies, they were houses that they were caretakers for a system that served the public good. So we had an entirely different time after the 80s, and we are now where we are with pension crisis, and we have guarantees that weren't sustainable. Equitable Life went on this back because of the guaranteed annuity options. There are guarantees sideways and back and forth and up and down. Nobody understands, they haven't the foggiest idea how to compare these things. So here, okay, competition is good. And product development is good when it comes to small-scale production of kebabs and of toilet rolls and things maybe. But when it comes to complicated products, products at a high level of sophistication, where the individual customer have no possibility to judge what the real value of a product is and what it really means, they have to be represented by a competent and strong regulator. That's, say like Forrest Gump, that's all I have to say about that.
One question here from the economist. You invoked the law of large numbers quite repeatedly. I'm a little bit wondering to what extent you actually have what I'd call aggregate risk in your setting, that is a component of the payout that is subject to some common shock. Is most of what you're looking at, or all what you're looking at, really diversifiable? What I would call diversifiable is something that goes away after application of the law of large numbers in terms of risk. What I'm been focused on, maybe we have a really very, very complementary talks. I was entirely focused on the risks that are not diversifiable, and you seem to be focusing on the opposite. Is it correct representation?
No. Okay, let us make this. Let me make this precise. All I say is that the law of large numbers applies to the portfolio. When you increase the size of the portfolio, the mean result will converge. If all the indices are fixed, the mean will converge against something fixed. If it is random, the mean will converge against something that is random. And there are all the non-diversifiable factors. They are the interest rates. They cannot be diversified through increasing the size of the portfolio. And there are the vital rates, mortality and so on. They cannot be diversified by increasing the size of the portfolio. Management of this non-diversifiable risk is, of course, the big issue. That is a big issue. And I have demonstrated two very classical approaches to this problem that actually solves these problems. And there can be shocks in the mortality, there can be shocks in the interest rate, everything. The point is, we do not need to model it. We only have to say that, okay, there is some random development, but we are always adapting the payments to this development. So we are always working in a conditional model, not trying to model the intensities, but we just take them at face value as they emerge. And then On top of this, we have idiosyncratic risk that is taken care of by the law of large numbers. And the risk associated with these non-diversifiable indices, it has to be managed by adapting the payments to the realities, so that people have to live and die with what these troublesome indices can afford. So bottom line on this is that good risk management in insurance starts with writing sensible contracts. And that's where it could end if it were done properly.